Today we're going over a company that has phenomenal performance. And know that when I say phenomenal, it is just that, phenomenal. If you look over the last 1 year, it's up 39%. If you look over the next 2 years, it's up 140%. Over the last 5, up 10,000%. Over the last 10 years, up 11,500%. It is extremely rare to see stocks of this caliber go up this much. Over the last 5 years, a 10,000% return, a 1,000% return over a 5-year period would be incredible. 10,000 is just phenomenal. If you look at this compared against some of the top performers, some of the biggest names in the industry, it doesn't even come close. The 5-year performance for Tesla is 700%. The 10-year performance is 7,000%. Now this company in many ways has deserved to go up in value. If you look just 5 years ago, where the company was putting up revenue numbers 5 years ago, during the quarter we're at right now, it was putting up $77 million in revenue. Now in the most recent quarter, it's almost 10x that, and it's now doing $634 million in revenue. Profitability has seen a similar story. Around this time 5 years ago, there was no profits, there was actually negative free cash flow, and today you have hundreds of millions of dollars. So what has taken this company to a level that is just unseen and unheard of? Well, this company essentially sells solar panel inverters. Not actually panels itself, but the inverters that are attached to them. Now, I'm not an expert in this field, and we're going to go over in this video a brief explanation of what that is, because I'm sure many of you do not know. Maybe it's just me, that's just a lack of knowledge in this space, but I'm not too familiar with this. But I want to talk in this video how, in my opinion, I think the stock has gotten out of hand. In the last 1 year, it's up 39%, and year to date, it's up 68%. Meanwhile, the market is down dramatically. This stock is up almost 70% year to date. And this company does not seem to be stopping anytime soon. Analysts are projecting that this company is going to continue to grow, and these solar panel inverters are going to continue to have higher and higher demand. We're going to talk about in this video if I think that's true, where they actually manufacture these products, the type of acquisition and growth opportunity this company is investing in, and then show overall some other financial metrics that are important for the business and why I think that this could be a potential short opportunity. It's not very often that I short stocks. Luckily, most of my biggest winners in 2022 have been from shorting, but honestly, with a market cap of $45 billion, I think it's starting to get out of hand. We're going to talk in this video why I think that is, what has changed for the stock, and why I could potentially be shorting this company over the next couple of months. So stay tuned, it's going to be a fun one. But before we get into all that, we have to talk about today's sponsor, MooMoo. MooMoo is a new up-and-coming brokerage that is taking the world by storm. Commission-free trading, level 2 data, advanced technical indicators, earnings calendars to see the date of financial statement releases, and institutional tracking to follow Warren Buffett's portfolio are just a few examples of what MooMoo has to offer. With this being my first sponsor in the channel, I have fully vetted their company and stand behind their vision. MooMoo currently trades on the NASDAQ under ticker symbol FUTU for FUTU and is SIPC insured. If you sign up today using my special referral link, then you can receive $10 plus an additional 15 free stocks pending certain deposit requirements. Free stock amounts can be as high as $1,000, so sign up now using the link in the description or pinned comment down below. You would help support me and my channel by doing so and give yourself an edge in the world of investing. Thank you so much, MooMoo, for sponsoring this video. Now back to the content. Okay, welcome back, and this little article here describes what this company does perfectly. In my opinion, it's the most simple article I can find for what a solar inverter actually is. Solar panels generate DC, which is direct current electricity, but your home runs off of the alternating current, AC electricity. So you have a problem. Your household needs some help to use the energy from the sun. That's where a solar inverter steps in. What is an inverter? A solar panel inverter's primary purpose is to transform the DC, which is direct current, electricity from solar panels into usable AC, alternating current, electricity for your home. Because of this, you can also think of the solar inverter as a solar converter. Since most applications use AC power, your solar power system has to convert this DC energy to useful electricity before it can be used to power those appliances. The brain behind this conversion is your inverter, inverter, which allows solar power system to provide energy to your electronic devices. Also, when a solar-powered home is connected to the grid, the inverter for home energy acts as the middleman between your home and the electric grid. This is what's called the grid tie inverter. The grid tie inverter allows your home to have uninterrupted power, no matter how much energy your solar panels are generating. In a situation where your solar power system is producing more electricity than your home is consuming, the photovoltaic, if I'm pronouncing that correctly, inverter can feed that extra power back onto the grid. Or you might be in a situation where your panels are producing some power, but not enough to run your entire home. So the inverter mixes the solar power with grid power. At night, when solar panels aren't producing enough electricity, your home may need 100% of its energy from the grid. Or the inverter might be able to make some grid power with some energy stored in solar batteries. Either way, it's the grid tie inverter's responsibilities to make sure your home has all the power it needs in any of these scenarios and you don't notice a change as it switches between them. Essentially, what you can read from this, and if you need to pause the video and read back over yourself, feel free to do so. But long story short, basically these inverters are the middleman for the power that is received from the sun onto the solar panels, and then it's distributed to your home. The part where it's distributed to your home, that's what these inverters do. So this company is not actually focused on selling actual panels, but the inverters themselves. And so far, this company has had a lot of success growing in the space. Year over year, the most recent quarter, the company's grown 80%. Not 8%, 80%. The profitability has seen a very similar story, growing 78% year over year, $179 million in free cash flow this year versus last year's $100 million. A pretty impressive feat that is not being able to achieve by most companies, especially going into this recession. This company produces positive ROCE, and then the profit margins are pretty steady. Most recent quarter was 18%. We've seen some as high as 56% depending on the quarter, but generally speaking, the average is right around 15%. Similar story can be said for operating margins, generally trending long-term around the 18 to 20% operating margins. The company right now is still diluting shareholders, but it is in a slow way, only growing about 0.5% year over year, but the company is not buying back shares as of today. Right now, they are increasing their cash pile versus their debt, which is something good that you want to see. They're loading up that cash pile, building up that war chest for the future, and they do that by being able to manufacture these very cheaply across the globe, primarily in India. But you can see they have other locations as well, and they are mainly focusing on acquiring other technologies, other hardware and software businesses that can help grow this company. They acquire many different businesses. They're buying a lot of different products and a lot of different companies. As you can just see, they've acquired 7 major companies just since early 2021. Since January 2021, this company's already acquired 7 major businesses. And if you look at some of the metrics for this company, you can see that it's pretty incredible. It doesn't matter if you're looking at quarterly revenue, quarterly gross margin, quarterly operating expense percent, quarterly operating income percent by year. You can see that generally speaking, everything for this company is trending in the right direction. And you might be watching this video and thinking, Jordan, everything you've said about this company so far is positive. What's the short thesis? Well, I have a couple things to believe. The first one is this company growing 80% plus year over year is going to come to a screeching halt, in my opinion. I think that this company will still grow, but you'll see significantly lower growth rates of maybe 20, 30% year over year, rather these ridiculous 80% numbers, because flat out, the recession's coming and people are not going to spend nearly as much on the type of products as they normally would. Now, for example, you can see other companies like Sunrun has had a very successful path in growing their long-term revenue, and even they are still growing 44% year over year. And many of these companies, we can keep on going down the list, but basically what it comes down to is all of these companies are hitting massive growth now, but they're all competing for one another. This one growing 58% in the last year. And long story short, the opportunity to grow revenue at these type of levels is going to come to a screeching halt. Now, what you might be thinking is, Jordan, they can continue this revenue growth. They will, it doesn't matter. It doesn't matter that obviously the recession's happening, people want to buy solar products, and the EV market is compounding by about 30 to 40% a year, and you might be right in saying that. However, this company's free cash flow is nowhere near what this market cap should be trading at, in my opinion. If you look at the company's free cash flow last year, they put up about $300 million in free cash flow versus the market cap's $47 billion. 47 billion versus 300 million. Basically, the free cash flow as of last year, the market cap is 150 times higher than that of the free cash flow. If you have a company that's trading 40 or 50 times the amount of free cash flow times its market cap, you already know that the company's expensive because people are paying a lot for its very small profits. This company has 150 times its last year's free cash flow. Now, it's easy to say it, the company's growing, so the free cash flow will be a lot higher today, so obviously that's a big argument that you can have against this. However, even if you look versus where the company's free cash flow is likely going to end up today, you can say that it's probably going to double, roughly, ending up around 600 million. Well, even if you take 45 billion and you divide that by 600 million in your calculator, you can see that the price to free cash flow is still 75. 75. If you divided that in half, if you took the stock price in half, it would still nearly be at a 40. It would be significantly higher than that of the average in the market. One more thing I might add as well, besides the fundamentals, is just the overall trend of the stock going up so much. Now, I know that this might be a psychological thing. Maybe it's just me just, being biased by the stock price going up. But I mean, just look at the momentum this stock has had despite all the recession, all the economic headwinds. This stock is just powering higher and higher and higher, and obviously a 68% return year to date is already very impressive, and we haven't even begun to factor in the price might be coming down due to this revenue growth slowing down. So it's not one that I'm short right now, it's one that I could potentially short, as this valuation, in my opinion, has just gotten way too out of hand. I think that it's a great company if you're wanting to hold this company for 5 or 10 years. I don't think it's a bad buy, but honestly, I think that the revenue growth opportunities is going to slow, and I think that it's very likely that the stock price a year from now when we're watching this video is likely going to be much higher. If I were just to give out a ballpark estimate, if I were just to flat out guess, now once again, this is a guess, I could be way off here. There's no telling what stock prices will do in a year, but if I were just to throw out a rough estimate for where I think Enphase might be in a year from now, I would say that the stock could very well be at $200 a share, maybe lower. So based on where we're looking at right here on the 5-year chart, basically it would have to go below these lows set back in October, and we'd have to go basically where we saw during around the summer of 2022, around $200 a share or so. Honestly, I wouldn't be surprised if it goes even lower to 150. The only reason I don't even say lower than that is because this company has so much momentum and so much belief behind it, the retail investors love it, and who knows, it could last a lot longer than I think it could. But long story short, it's one that I'm watching, one that I'll keep up with, and of course, I'll always show you guys what I'm investing in, as we currently have 37,166 invested. My holdings that I have that I disclose in every single video are right here, and my performance versus the major indexes. These are the type of performance opportunities that I'm looking at for shorting stocks that reach sky-high valuations, record levels, mass momentum, and opportunities to short the stock as they hopefully come back down. Thank you guys so much for watching. Sign up for MooMoo down below if you haven't already, and I'll catch you guys next time.